Hello and welcome back to Dividend Destiny, the home of international income investing. Today I'm going to go through our first Canadian stock that we've added to our portfolio, and that stock is Enbridge, and it currently trades at $49.47. That's at the close of trading today on the 21st of June, but we actually made our first purchase on the 1st of June for around $46. A bit of background on the company: it's one of the big oil majors in North America. They want to be the leading energy delivery company in North America according to their website. They operate across North America, fueling the economy, people's quality of life, and they actually account for around 25% of the crude oil movements produced in North America and transport nearly 20% of the natural gas consumed in the US. They also operate the third largest natural gas utility by consumer count. In terms of renewables, they have an allocation in renewable energy, offshore wind assets, and there is a small allocation, I believe it's around 3 to 5% in nuclear. So they have growing markets throughout North America across these four core businesses. You can check them out on the website. In terms of dividends, they have a strong commitment. They are a dividend stalwart, so their commitment is to pay robust dividend income. And I think the yield that we locked in was around 7%, which is market-beating yield. You'll struggle to find that anywhere on the market at the moment, certainly in the American markets, TSX and others. So they have a unique value proposition that brings together a combination of transparent growth, a reliable, low-risk business, and significant dividend income. And they have increased the dividend with a compound annual growth rate of around 10% per annum from 1995 to 2021. That's 26 years of dividend growth in Canadian dollars, which is very impressive. They have a consistent track record of delivering annual dividend increases. The continuing goal is to deliver superior shareholder returns through a combination of capital appreciation and dividends as well. So in December last year, they actually announced a 3% increase to the annual dividend. That's around 0.84 cents per quarter, or $3.34 per annum. So that's very, very good from our perspective as investors in terms of a backbone to the portfolio and a very good stock in our opinion to begin with. They are committed to as a dividend payout ratio of 60 to 70% of distributable cash flow. That's a non-GAAP measurement. In terms of the oil price, we know that it's been beaten down because of the ongoing global situation. But as we come out of that, we strongly believe that the oil price is going to go up. The famed ARK Invest fund manager, Cathie Wood, weighed in on this. You can check out this article on Seeking Alpha, where she struggled to see a $70 ceiling. Her view was that we're going to see renewables come to the fore, electric vehicles, and we would definitely struggle to see $70 a barrel again. Well, you can see that it's a month later, and the Brent crude oil is at $75, and the West Texas Intermediate has just gone past 70. So that's in a month since Cathie's original speculation. So yeah, that's going to translate into more profits for Enbridge and more cash flow as we hopefully come out of this global situation. Just a few other metrics that we performed on the analysis. It was trading at a price to book of 1.8 when we made the initial purchase. Price earnings of 15.5, trailing 12 months. Forward 15.8. The beta on the stock, so the volatility, is 0.92, so it's around as volatile as the market. So it tends to track the index. That's based on the 5-year monthly calculations. Price earnings growth was calculated at around 2. Now, if it's above 1, you would classify the stock as being overvalued. But when you actually factor in the dividend income, so the dividend adjusted PEG ratio, it actually comes out at 0.7, 0.68, which is very attractive. And the consensus for earnings per share growth is about 15% by December 2021. And that would be, we could use more conservative estimates, of course, but they're the analyst estimates from Seeking Alpha. And they beat the latest earnings anyway by about 8 cents. So in our view, it's paid dividends for 66 years. They have a strong commitment to continue to do that. The compound annual growth rate of the dividend, which is what really rockets your portfolio. It's the real afterburner for your portfolio. It's a multinational pipeline based in Calgary. It's the longest pipeline infrastructure system in North America. It's about 5,000 kilometers. They have a natural gas allocation. They've got a commitment to move into renewables, which is very impressive. The only headwinds that we can see at the moment are the attention that the company gets from protesters around the pipelines, the climate issue as well, the shift to renewables, the pressure from that, and the debt pile. There's a debt to equity of around 1.1. And then just going through a bit more about the valuation, I will show the portfolio in time, and as well as some of the valuation processes that we use. But we essentially just use the dividend discount model here. So just to sum up, we use the iShares Canadian Government Bond ETF, which has a yield of around 2.3%. So we used a 2 to 3% discount rate, which is what you could earn elsewhere. And the stock was trading at $46. Annual dividends of 3.34. And based on that discount rate of 2%, the stock would be valued, if we discount those future cash flows back, the value of the stock would be around $226.18. So that implies that presently it's 80% undervalued. If we use the discount rate of 3%, it's actually $164.78, which is still 72% undervalued. So again, you have to be you have to take these calculations with a pinch of salt, but we can see that at least from the summations that we've used, the perspectives, it's an undervalued stock still, and yet it's yielding like 7%, which you'll struggle to find that anywhere else on the TSX. So we hope you enjoyed that valuation and presentation, and we'll be covering the other assets in the portfolio in due course and doing more videos on how we value things and different aspects of investing for beginners. So thanks for watching. See you next time.